Welcome back to Startup Accounting 101. This is a video series for founders to understand accounting fundamentals for starting up a business. We're moving through this financial projections template. It's free from score.org. Just go to the template gallery and download this template. I'll put their link in the description below. So this video will cover tab 3A. It's a sales forecast for year one. In the last video, we covered COGS per unit for two product lines. One is candy bars and the other website redesign. Now we can look into the sales of the business. Now the sale price is really the top line or gross revenue for the business. This amount needs to cover all the business needs. And that's why it's important to calculate COGS first, so we can properly price the products and services. And we can go to the calculator here. COGS, or cost of goods sold, are known as variable costs. These costs depend on how much you sell. So the more you sell, the more COGS you will have. And that's why it's variable. When one goes up, the other will also go up. So based on this calculator, there's some information here I'm bringing into the forecast. So the COGS per unit for each item, as well as the number of units per month. So we're returning back to the sales forecast. So all this information we're going to bring in COGS per unit, and the margin per unit, that's what's left over after paying or accounting for COGS. Now this is the amount that covers the other company cost. Fixed costs are costs that you have regardless of sales. So within the margins, you need to cover your fixed cost. We've already calculated one type of fixed cost here, which is payroll. And for payroll for year one, that's roughly $400K. And yes, some of that has already been incorporated into COGS. So the margin here needs to cover any remaining payroll expenses and the other operating costs. So here at the top section here, for each product line, there's total units, sales price per unit, COGS, and margin per unit. Now for food and beverage CPGs, like a candy bar, you can sell your products in many different locations. Like you can sell D2C, or direct to consumer, on an e-commerce or a Shopify site, at a farmer's market, even Amazon FBA, or fulfillment by Amazon. You can also obviously sell your products at Costco, Target, Walmart, Whole Foods. So all of these different sales channels could have a different sales price. So I have here 3 different examples. The first one is MSRP, or manufacturer suggested retail price, and this is the price that the customer pays. So typically the D2C channel will use this MSRP price. You'll also here have a wholesale price, and that goes to most retailers. Now certain retailers like Costco will have their own specialty pricing. And when we look at the different sales channels, we can see that there's a different price. Okay, it's different for each sales channel, but the COGS is the same. COGS per unit remains the same. Now note about this, like IRL in real life, different sales channels could have different like packaging requirements, and that would change the COGS between like the different channels. But for this template, we're keeping COGS per unit the same for all sales channels. So based on the calculator, COGS calculator, we calculated that each candy bar was roughly 39 cents per candy bar. And the different sales price that I'm estimating is, $4 direct, $2.50 is the wholesale price, and then Costco is going to have a price of $2.25. And you can see that the margin per unit changes depending on where I'm selling the product. So this all is going to translate here. Now here is, we can see the total sales, total COGS, and total margins for the different product lines here. And these formulas are driven by the number of units sold. So these orange sections here. And based on COGS, the calculator, we know that we can produce 25,000 candy bars a month. So with that 25,000, like where are we going to sell these products? Like how are you going to split up the 25K between the 3 different sales channels? And also you'll want to estimate any seasonality for the business. So in October, because of Halloween, we're expecting double the sales, and you're also going to hire more part-time employees, work overtime, to produce 50,000 bars for October. So that's here. So we're forecasting, estimating being able to sell roughly every month for the most part, 5,000 candy bars direct, and then 10,000 for each of the wholesale and the Costco channels. Now, these channels, they're major retailers. They can drive more sales. And yes, the margin is lower for these channels, but we should expect much higher sales volumes. And over time, successful food CPGs, or consumer packaged goods, the wholesale and retail channels, these 2 channels, will drive a majority of the revenue for the business. So that it's important to make sure that the sales price that are set for these channels are profitable. Okay. So off to the side here, we can see category breakdown and category over total. The category breakdown basically shows the margin per product line. So here for MSRP, we can see that it's roughly 90% margins. Wholesale is 84.4 and Costco is 82.7. And these may seem like a lot, but remember that the margin here needs to cover all of the other business costs, both fixed and variable. An important piece is trade spend. Discount, promotions, deductions, any other incentive to encourage retailers to stock and promote your products. Trade when is one of the most complicated areas of working with retailers. Like I could easily create a series just on trade spend alone. I'll definitely cover trade in later videos. For now, just know that it is a significant investment, and you need enough margin in the wholesale and the retail sales to comfortably cover trade. Now, as consumers, we don't like to see high margins, but I've worked with Primal Kitchen and Liquid IV, and I'll be honest, 80 to 85% margins might feel a little tight, especially for startups. If you're not profitable at the wholesale price, like the business is not going to be sustainable in the long run. And just be mindful that the wholesale price will always be significantly less than MSRP. That's the case for any CPG company. That will be the case because retailers, they need to make their margins as well. Right. And once you set these prices, these sales prices, it becomes an anchor. And raising prices is going to be difficult. I mean, customers generally don't take too kindly to a price increase unless there's a really substantial reason for it. Um, and the market has a ceiling for how high the sales price can go. Like for candy bars, I mean, are people really going to buy candy bar at $10 a bar? I don't know. Like, I doubt it. It would have to be a super, like, ultra premium product to merit a really high price point. Okay. So that's product COGS. So we're now moving into service-based COGS. So I do have website redesign here in the product lines. COGS again is typically not part of the financials for service-based companies, but there is value in doing this just to make sure that you see, the profitability per project. This is really sort of the best case scenario. You've got no major issues or like endless rounds of redesigns. But you do want to have a little bit of a buffer in case there's more time needed to complete the project. Because the more time you spend on a project, that's going to eat into your margin. So here, website redesign, we can produce one a month. So we'll just put one here. And the margins per project is roughly 33% here. Um, so the last column here is category per total. And so this column helps to see the sales concentration of your products, like at the company as a whole, like where are the sales coming from. So this can help you as a business owner to know how to focus your limited time, energy, and resources. So for this, just to see the breakdown of candy bars, I'm going to zero this out. So for the candy bars, we can see in year one, it's a fairly even split. Like here is the percentage of, category by total. So we can see that MSRP in Costco is roughly 31% of sales, and wholesale has a little bit more, or it's driving more of the margin or profitability. It's about 38%. And the total margin, like in terms of dollar value, is down here. So the total margin is roughly 750K. All the COGS are covered at this point, and you've got 400K roughly on payroll. So doing the math, you have roughly 350K to cover all the other costs. And again, that could cover trade, rent, insurance, any other expenses. And we actually go and estimate some of that in later tabs over here. But for now, we've completed the sales forecast for year one. In the next video, we'll be forecasting the sales growth for years 2 and 3. Like and comment if you found this video useful. Let me know if you have any questions. And please subscribe. I'm trying to get to 500 subscribers on this channel. Thanks.